Let's say you decide to sell your house. Maybe you're moving for a new job. Maybe your family is growing. Or maybe you just want a change of scenery. Whatever the reason, there's a chance you encounter something called capital gains tax. Tax that comes into play when you sell real estate in the United States for more than you paid for it. But what exactly is this tax, and who actually has to pay it? First, let's break down the basic idea. Capital gains are simply the profits you make from selling an asset. In this case, the asset is real estate, a house, a condo, perhaps even a plot of land. Here's how it works. If you bought your home for $300,000 and sold it a few years later for $400,000, you made what's called a $100,000 capital gain. But before the IRS comes knocking, there are a few important things to know. In the United States, not every dollar of profit from selling your home is automatically taxed. There's something called the primary residence exclusion, and it can make a huge difference. Here's how that works. If you've owned and lived in your home as your primary residence for at least 2 out of the last 5 years before you sell, you can exclude up to $250,000 of capital gains from your income if you re-single or up to $500,000. If you're remarried and filing jointly, let us go back to our example. You're remarried and sell that same house for a $100,000 gain? That's way less than your $500,000 exclusions, so you pay zero capital gains tax. But what if you bought a rental property or a vacation home? The exclusion only applies to your main home, the property where you spend most of your time. Profits on rental properties or second homes are fully taxable as capital gains, no exclusion allowed. Now, let's say your profits are greater than those exclusion thresholds. If, for example, you and your spouse bought a home for $200,000, lived there for 15 years, so how much is that tax? Here's where things get a little trickier. The tax rate depends on how long you owned the property. If you owned it for more than a year, what's called a long-term capital gain, the rate is either 0%, 15%, or 20%, based on your income level. Most people fall into the 15% category. If you own the property for a year or less, your gain is considered short-term and taxed at your ordinary income tax rate, which could be much higher. For most real estate sales, especially with homes, long-term rates apply. But wait, there's more. Capital gains tax isn't just a federal issue. Many states also tax your capital gains, and the state rates can vary widely. For instance, California taxes capital gains as ordinary income, meaning the bill can be hefty, while states like Florida and Texas have no state income tax at all, so no state capital gains tax. If your sale involves a rental property, there's an extra wrinkle called depreciation recapture. Over the years, you may have claimed depreciation on your rental property to reduce your taxable income. When you sell, the IRS wants some of that back. Depreciation recapture is taxed at a maximum rate of 25%. So, the gain you made from depreciation is taxed separately, and then the rest is taxed as a standard capital gain. Now, what if you want to avoid paying any capital gains tax? Some investors use something called a 1031 exchange. This allows you to sell an investment property and reinvest the proceeds in another similar property, delaying the tax bill. The rules are strict. You have to identify the replacement property within 45 days and complete the purchase within 180 days. You're just postponing the tax, not dodging it forever, and the IRS is watching closely. A few other points worth mentioning. If you re-forced to sell your home due to work, health, or unforeseen circumstances, you may qualify for a partial capital gains exclusion if you live there 2 full years. Every situation is a little different. And finally, for those who inherit property, the rules shift again. The IRS sets the cost basis as the property's value on the date of the previous owner's death, not what they paid for it. That can mean little or no capital gains tax if you sell soon after inheriting. So in summary, capital gains tax on real estate in the United States depends on what kind of property you're reselling, how long you've owned it, how much you've lived in it, and what state you're in. With exclusions, loopholes, and plenty of exceptions, the rules aren't exactly simple, but when real estate changes hands, the taxman is rarely far behind. As always, if you're planning a sale, it's wise to talk to a tax professional, just to make sure you keep as much of your gain as possible and avoid any surprises when tax season comes around.